You had some fiat, you bought this derivative, the asset manager went and bought some Bitcoin and they put it in a custodian and it sits there, right? So in a sense, if the BlackRock ETF gets too big, it could actually kill Bitcoin because it's just a bunch of immovable Bitcoin that's just sitting there.
Hey guys, welcome back to Everyday Finance. In this video, Arthur Hayes discusses about Bitcoin. According to Arthur Hayes, depending on the cycle, Bitcoin fluctuates as Arthur Hayes attempt to advance and assert that the essence of the Bitcoin price is fiat liquidity with technology. So for the time being, we're concentrating on the fiat liquidity aspect, which is acceptable because there is a lot of fiat, which raises the value of Bitcoin. Whatever the case may be, that move goes in cycles since interest rates move in tandem with the credit cycle. The price of Bitcoin will fluctuate as liquidity increases and decreases. But when you start concentrating on the technology, what is the peer-to-peer decentralized money system behind Bitcoin? Arthur Hayes say, I can possess $1 billion in my mind. Technology is an asset worth $1. And when Arthur Hayes have fiat liquidity and Arthur Hayes add the technology to it, Arthur Hayes say, I get what I refer to as double happiness, experiencing the largest bull market in history, because if those investors begin, the global bond market is worth several trillions of dollars, challenging the idea that at the portfolio level, bonds are lowering volatility, and that governments are willing to take whatever necessary action to keep the relationship intact when it comes to energy markets' purchasing power wholly, like the sky is a restriction on the locations of Bitcoin tech stocks, and lots of things Arthur Hayes discuss. So please watch the video to end. And share this video, and subscribe our channel Everyday Finance. Thanks.
I think it's a legitimate viewpoint, but the things that people appreciate in Bitcoin changes depending on the cycle. I try to move up a level and say that simplistically, Bitcoin price is fiat liquidity plus technology. So right now we're focused on we usually been focused on the fiat liquidity piece, which is, okay, there's a lot of fiat, therefore Bitcoin's worth whatever it's worth, right? And that moves in cycles because the credit cycle moves, interest rates move, the liquidity expands and contracts. And so the Bitcoin price will do that as well. But when you start focusing on the technology, what is the technology of Bitcoin? It's peer-to-peer decentralized money. It's that I can own $1 billion worth of an asset in my brain. That's the technology. And when I have the fiat liquidity and I add the technology to it, then what I get double happiness. I get the biggest bull market that we've ever seen, because the global bond market is however many umpteen trillions. If those investors start questioning the premise that bonds are volatility reducing on a portfolio level, and that governments can do what it takes to maintain the bond market's purchasing power in energy terms, then holy fuck, the sky is the limit on where Bitcoin, tech stocks, any of these farmland, Patek Philippe watches, whatever it is that you want to view, it's just going to all go nuts because there's so much money in bonds. If people lose faith in the bond market and this fiat artificial construction that we've created over the last 80 to 100 years, this global economy and how it's been structured, if we lose confidence in that, then the amount of money that's going to be looking for an alternative is going to be something that we've never seen before.
Arthur Hayes believed that the BlackRock ETF and any upcoming ones have the potential to draw attention to a scenario that we might not ultimately find favorable, such as if Larry Fink and his stepfilk enters and takes up a significant portion of the free Bitcoin. You may be aware that there is freely traded Bitcoin in use. Additionally, ETFs such as mining ETFs and BlackRock have been introduced. Controls, who are Asians, are the biggest shareholders of several of the biggest mining companies, state BlackRock, and select a different asset manager that is currently operating in a specific jurisdiction. If the government requires that we all sit on fiat money or in the fiat banking system, what steps should they do right away? It would make sense for them to permit an ETF like that. If they could use inflation taxes to collect the debt, our money is kept in this vehicle, BlackRock, which was merely another bank. And you can't really utilize Bitcoin, not the actual Bitcoin itself, but a financial asset. You can't gift your mother a few Satoshi to experiment with it, or compensate someone abroad to purchase some goods. No, you purchased this derivative from the asset manager with some fiat, went and purchased some Bitcoin, putting it in a custodian and leaving it there, acting as the BlackRock in a sense. When an ETF grows too large, Bitcoin may really be killed since it will just be a collection of immovable coins that are left in one place. Let's back to the Arthur Hayes interview.
And if BlackRock and Fidelity and Vanguard start offering mining ETFs and start owning a large percentage of the largest miners in Bitcoin and other blockchains, then we've get to the situation where if we need certain types of upgrades to enhance the privacy, enhance the encryption, to make sure that it maintains this rock solid, cryptographically hard monetary asset, those interests are not aligned with the TradFi statist institutions. And so would they support that? Open question. I don't know. But that's what happens when you have these large passive investors. You can see what havoc they've wreaked on sort of the oil and gas industry, right? Larry Fink went on this whole ESG nirvana like he gave a fuck about this kind of stuff because it was politically correct to do so, and starved capital from oil and gas companies around the world at the boardroom level because of the impact that BlackRock has. And what happened? We wake up a few years later like, oh shit, the only reason some of these technologies are cheap is because China was willing to pollute their environment to flood the market with polysilicon and other things. Actually, we should have been investing in oil and gas infrastructure so that we could actually produce more oil and more gas in an economically efficient way. But because we believed in some bullshit ESG stuff and Larry Fink owns 20% of some of these stocks, these companies couldn't do it. They weren't getting capital to build, and now we're in this structural inflationary situation. So we've already seen what passive investing can do to an industry because of the shifting political and social winds that are grounded in science. What can it do this time when we have a currency like Bitcoin, which is the antithesis of status money that is here for us, the people, that have the ability to send money around the world, owned by one or few institutions, right? So not to say that it's not all going to end up okay, but there is that risk. And yes, it's going to be great for the price in fiat terms. Was it actually going to be great for the usefulness of Bitcoin? And are we, gaining a sugar high today to only engender a massive calamity in the future? I don't know. So I think people need to start thinking about that a little bit more long-term versus, yes, okay, ETF comes, price pumps to whatever it pumps to, but what's the net result of one institution holding all this crypto? So there's always going to be the new thing. So if you're, last cycle, it was all these L1 blockchains that were going to be faster than Ethereum and they cater to some particular ecosystem, right? The Solanas, the Aptoses, and all that dog shit, right? And so most of those, you get one shot, right? They had the one massive pump in 2021, and now everyone's like, well, you actually didn't really do very much, and so you're not going to pump again to your all-time high. So I do believe in that sequence of Bitcoin first, then ETH, then everything else. Now, obviously, at Maelstrom, we play along all the cycles, right? We want to invest in quality infrastructure, and we want to invest in dog shit meme coins. Like, we're trying to make money here, right? And so, like, if you want to think about what's going to happen at the end of the risk sector, it's got to be something new. Whatever it is, the new narrative. I've put out there this AI crypto narrative, and I have a stake in Filecoin and a mining company, other things like that. It could be some particular type of Web3 gaming. It could be some particular type of way that we do social graphs on Web3. I don't know, but we'll see the zeitgeist change of what people are actually focusing on, and new projects that are unproven will, at the end of the cycle, say, oh my God, there's so many people in crypto. Look at all the wallets created. We're going to have all these clients. They're going to do all this stuff. And it was, yeah, right. This is really great. Let's go. And these tokens are going to pump. And again, they'll get crushed just like everything else because consumer adoption is hard. Getting people to change ingrained behaviors is hard. And so, yes, I think it's going to play out much the same as the last cycle. It's just that the types of things that we believe are going to be the next game changers is just going to change. Maybe it's not going to be the BlockFis of the world. It's going to be custodians. And maybe it's not going to be that they, lent money to Muppets like Sue and Kyle at €3. It's going to be, you have a back office person that makes $75,000 a year who got socially hacked, and all of a sudden trillion of crypto got stolen, right? So I think it's a different type of thing that's going to take us down. But I think the sequence that you presented is pretty accurate in terms of my worldview.
According to Arthur Hayes, a significant portion of that can be attributed to Bitcoin and cryptocurrencies emerging as a response to events occurring in the Tri-5 fiat world. Currently, governments refinance themselves approximately every 3 to 5 years, resulting in a credit cycle of 3 to 5 years. Is it possible that a catastrophic event will occur that fundamentally alters our perception of how economics and government finances ought to be conducted? Similar to the King's post-World War, Arthur Hayes period, or the course of events leading up to World War. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.